Thanks for tuning in to our Birkenroad Reports video presentation. Today, my equity research team will provide an in-depth analysis of poultry processing company Sanderson Farms. I'm Emily Cornay, and I'm going to give a brief overview of Sanderson Farms and explain the company's role in the poultry processing industry. Sanderson Farms is a fully integrated chicken processing company. Capturing 5% of the market share, Sanderson is the fourth largest poultry processor in the United States. The company was founded in 1947 and is currently headquartered in Laurel, Mississippi. With production facilities spanning the southeastern region of the United States, Sanderson has 7 feed mills and 8 hatcheries located in Louisiana, Texas, Mississippi, Georgia, and North Carolina. Sanderson Farms produces, processes, markets, and distributes a variety of chicken products. Sanderson focuses its operations on the chicken industry's largest segments, which include big bird deboning and chill pack retail. Customers include national, regional, and local supermarket chains, casual dining operators, and distributors that resell products outside the United States, mainly to Russia, China, and Mexico. Major customers include Sysco, Winn-Dixie, and Safeway. Sanderson's tagline is 100% natural, and the company positions itself as an environmentally friendly producer of natural additive-free products. The poultry industry is very volatile, with fluctuations in commodity market prices materially impacting the industry's profitability. Sanderson maintains strength in constantly changing market conditions with several strategies. Sanderson prides itself on efficiency. It is consistently one of the lowest cost producers in the industry. The company focuses on producing retail tray packs, which generate the highest margins. The company has a track record of generating strong internal growth and delivering above-average returns. Sanderson recently opened a plant in North Carolina and is already planning to construct another plant in the state. The company has a strong balance sheet with a conservative capital structure that allows the company to persevere in industry downturns. Sanderson's peer group includes Tyson Foods, Pilgrim's Pride, and Kegels. Although Sanderson is not an industry leader in terms of financial and marketing resources, it competes with larger companies based on product quality and variety, brand awareness, and customer service. Excluding Kegels, compared to its peers, Sanderson has a relatively small market share and therefore yields lower revenue than its peers. In fiscal 2010, Sanderson had a higher net profit margin of 7% than Tyson's 2.74%, Pilgrim's Pride's 1.88%, and Kegel's 2.31%. A higher net profit margin indicates that Sanderson has better control of its costs than its competitors do. Sanderson's return on equity of 25.05% outperformed its peers, which indicates that Sanderson efficiently generates profit from its shareholders' equity. Sanderson has a substantially lower debt-to-equity ratio than its peers, which emphasizes the company's strong balance sheet and low exposure to financial risk. Also, with a yield of 1.67%, Sanderson has the highest dividend yield among its peers. The company has a track record of continuing to pay dividends during industry downturns, which is an attractive trait that captures the attention of value investors.
I'm Tori Brown, and I'm going to discuss Sanderson's prospects for fiscal 2011. Sanderson's largest obstacle is the increasing cost of corn, which is the main ingredient in the feed that the company produces and uses. Feed costs account for approximately 50% of the company's cost of sales. Consequently, a change in the commodity prices of corn and soybean meal have a significant impact on Sanderson's bottom line. Unfortunately, Sanderson's feed position remains largely unhedged, unlike its competitors with feed contracts that extend until at least July 2011. The increase in feed costs will continue because of the tightness of corn and soybean meal supply. Furthermore, federal government mandates requiring higher ethanol blends for renewable fuels will considerably decrease the available corn crop that poultry processors use for chicken feed. The Environmental Protection Agency is trying to further increase ethanol mandates, which will profit Midwestern farmers at the expense of poultry processors. This graph shows the corn usage for ethanol production in the United States dating back to 1994. Brock's Associates estimates that the United States will use 40% of the U.S. corn crop to produce ethanol in 2011 and 2012. In terms of supply, the poultry industry currently faces a surplus, and Sanderson's reluctance to cut production will test the strength of the company's balance sheet. For the industry to recover, chicken prices must increase to offset high feed costs. Because demand will not increase until employment levels improve, the industry will have to cut supply. Contrary to the negative industry outlook, Sanderson refuses to decrease production in the short term, and in fact, Sanderson will continue to expand its production capacity. In the short term, with a debt-to-equity ratio of 9.78%, Sanderson's strong balance sheet will sustain the company's decision to not cut production, whereas competitors such as Pilgrim's Pride, which has a debt-to-equity ratio of 120%, will be more inclined to cut production. In terms of demand, weak food service demand is fueling a shift toward retail demand. High unemployment rates cause consumers to frequent grocery stores in lieu of dining out at restaurants. Sanderson is unable to adjust to shifts in demand because the plants that cater to each market require different equipment. The company is heavily weighted toward big bird deboning, which is a component of the food service market. When feed costs are high, big bird deboning is significantly more costly than retail. An increase in demand will be far too narrow to cause a poultry price increase that will offset high feed costs. Traded on the NASDAQ under the ticker symbol SAFM, Sanderson's stock is highly volatile. The company's stock performance reflects the conditions of a cyclical industry. Both 2008 and 2010 show large dips in the stock price. Nonetheless, Sanderson has the highest average annual return compared to its peers. Also, Sanderson frequently repurchases shares of the company, thus signaling management's confidence in Sanderson's operations. During the fourth quarter of fiscal 2010, Sanderson repurchased approximately 665,000 shares of common stock. Sanderson's repurchase plan of 1 million shares authorizes approximately 288,000 remaining shares for repurchase. 9 of the top 10 investors are institutional owners, and Joe Sanderson Jr., the company's CEO, is an inside holder with 4.23% ownership. Sanderson's 319 institutional investors hold approximately 89.43% of outstanding shares, with the top 5 holding 43.91%. These top 5 institutional investors are also the top 5 overall investors. Since such a small fraction of shareholders hold a large portion of outstanding shares, if one of these investors chooses to liquidate its position, the stock price could drop significantly.
Hi, I'm Roxanne Lu, and I'm going to discuss our valuation of the stock. We give Sanderson Farms a market underperform rating and project that the 12-month target price will be $43. To forecast the target price, we use the price-to-book value method and the discounted cash flow method. Although we give the company a market underperform rating, we believe that the company's stock price will bounce back when chicken prices reflect input costs. Low stock prices over the next year may give long-horizon investors an opportune entry point. Over a long-term horizon, we are positive about the company's prospects, for we feel that the company has solid management, strong financials, and that management's values are aligned with shareholder values. Sanderson is an excellent company in the highly cyclical industry. The poultry industry outlook is fairly poor in 2011 because chicken prices are not high enough to offset the high costs of feed ingredients. Therefore, we predict negative earnings per share for Sanderson Farms in fiscal 2011. Sanderson has survived industry downturns like this in the past, and we believe that its strong balance sheet will allow the company to recover quickly. Also, the industry is sensitive to macroeconomic factors, and we believe that the recovering economy and decreasing unemployment rate will positively impact Sanderson's financial performance. To predict revenues, we used Urner Barry and Georgia duck prices, Sanderson's average weekly production capacity, the unemployment rate, and seasonality. To predict cost of sales, we used pounds of chicken processed, corn prices, and soybean meal prices.
On February 18, 2011, our research team embarked on our journey to Sanderson Farms plant in Macomb, Mississippi. We toured the hatchery, feed mill, and processing plant and met with CFO and Head of Investor Relations, Mike Cockrell, for an informative question and answer session. Thank you for watching this video. For more information about Burkenroad reports or to learn more about our analysis of Sanderson Farms, please refer to our written Burkenroad report, which can be found at www.burkenroad.org. The Burkenroad reports are produced solely as part of an educational program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.